Hello? Anybody there? Anybody there? Hello. How's it going? How is everybody doing today? Happy Friday. It's currently 1 p.m. Mountain Time. I'm going to hang out for 45 to 55 minutes, and then I have to go by the start of the following hour. Hello, how's everybody doing? Hello from Fort Lauderdale. Fayaz asked Chris, how are you? I'm doing well. Thanks for asking. I was just watching one of your previous videos. Thank you. Which video? Should I YOLO all in GME now? No, you should not. GME's done. GME will not go back to $300 a share. GME will not go back to $200 a share. Mark my words. I think it's highly unlikely. Let's see, let's see what the borrow cost is. Yeah, the borrow cost is not that hard. It's not that much. First time on your channel. Welcome, 3K, 3 King. I think that's how you're intending your name to be read. Micah asks, you're a smart guy. Crypto, Bitcoin, Ethereum, what's your thoughts? I am a long-term Bitcoin holder. So I bought the majority of my Bitcoin at around $10,000 to $11,000 per Bitcoin. And now it's at 57,000. Let's see. Bitcoin is at 55,000. So I have 5.5x on the Bitcoin, and I have absolutely no intention of selling any of it anytime soon. So I am all in. I believe in Bitcoin. I think this is the start of something very exciting. Ethereum, I'm not as well versed in. I don't really have a deep knowledge in all of the altcoins. I have some friends that live in Denver with me that they know a lot more about the altcoins than I do, but for now, I'm focused on Bitcoin, and I'm a big believer in it. And I think if you're watching this right now and you have no exposure to Bitcoin, I would reconsider that. Do your own research, though. I'm not gonna tell you that you have to buy X% or whatever. I just think that it would be a good idea for you if you have no exposure to Bitcoin. I think you should educate yourself, which I will also do some videos in the near future on Bitcoin. But for the time being, I think it would be a good idea to read about Bitcoin and what it represents, and then read about everything that's happened in the past year, and then decide for yourself whether or not you want to get involved. Zombie says, loves how I break down the whole process on the beginner options trading video. Thank you. I appreciate that. That video is a big project for me. It really wiped me out. Probably took me 100 hours overall to put together that video and get it on YouTube, and I'm glad that it's helped so many people. It's got over 6 million views at this point, which is insane. All right, I'm going to go down here. Yada, yada, yada. What's up with Tesla? What's up with Tesla? Let's go ahead and take a look. Tesla's been quiet recently. I think that's what you mean by what's up with Tesla. Yeah, I think Tesla is just kind of taking a breather. Obviously, if we look at this chart here from March of 2020, it was 75. It was less than $100 per share, and this is factoring in the split that they did, and now it's $780 a share. So the stock price has gone up 10x in a year, less than a year, and so it's only natural after such a run up that it takes a breather. So right now Tesla is just kind of chopping around, and we'll see what happens in the next couple months. People are asking about Palantir, PLTR. Palantir is something that I'm not currently invested in, but Palantir they're getting some backing from ARK Invest, which is a company that I really like to follow. That's Kathy Wood. If you don't know what she's about, I think she is the sole founder of ARK Invest. I could be mistaken, but she's been talking about Palantir recently. I have not really read her comments or read what they think about it, but I need to do more research on Palantir. I'm currently not invested, but it is something that I need to get around to. What do I think of AMC? I don't really think much of AMC. I think AMC was another one of those GameStop short squeeze stocks that everybody was hyped on because it had a high short interest, which means there were lots of people betting against AMC. And for that reason, they thought that AMC was also going to go from $10 a share to $300 a share in a big short squeeze, but that didn't really pan out. Where is AMC right now? $5 a share, that sounds about right. So nothing really happened there. So I think this short squeeze era is over for now. I think GME will remain below $100. I think this is it's come and gone. So I would not place any huge bullish bets on GME. I think that's a gamble at this point. Somebody else said Palantir is something I will hold for 10 years. I like it. I like your conviction. I got to catch up here. Thank you for the super chat. Tell ya. Hey Chris, just want to know, is there a perfect time to enter a non-directional spread? 45 days to expiration, or can we sell one iron fly or condor every single day? It's an interesting question. First of all, people ask me a lot, and I've gotten some emails recently along the lines of, how do I know when to enter this position based on if it will be profitable or not? And they're kind of asking along the lines of, how do I know before I enter a trade whether or not it will be a good time to enter that trade? And the unfortunate answer is that you never know what's going to happen with a trade. And even if you think it is an ideal environment for that position, it could very easily not work out. And so answering the question, is there a perfect time to enter a non-directional spread? No, there's never a perfect time. There may be better or worse environments. For non-directional spreads, typically, I would argue that a lower volatility environment would be a better environment for a non-directional spread than a high volatility environment. And in terms of selling one iron fly or iron condor every single day, you could do that as well. But first of all, you have to understand that you have to approach that strategy in a way where you're actually going to be able to enter one single position or one iteration of that trade every single day. So let's say you have 30 days of entering these positions, and you're going to put $1,000 into each of these trades. Well, then you know that you need to have $30,000 of available buying power or margin requirement so that you can put $1,000 into a new position every single day. And there are some theories around that, meaning that if you enter an iron condor every single day, or you sell an iron condor every single day, then you'll have slightly different strike prices every single day because the market will go up, and then you'll sell this iron condor, the market will go down, you'll sell this iron condor, and you'll kind of average out your strikes. But it'll be a difficult strategy to manage because you'll most likely have some strikes that'll overlap, and then what happens is you'll have let's say 5 short puts at this strike price, but then you'll have short calls and long calls at different strike prices, and then it'll become very difficult to understand which iron condor is which. So I don't really like the entry every day strategy because I think it will get out of hand in terms of managing that position, but I like the theory behind it. Thank you for another super chat. SS, $5. I appreciate it. They ask, using iron condors for earnings trade, please. Thanks, much appreciated. I guess that's not so much a question. I guess they're asking, is an iron condor a good earnings trade? And I would say an iron condor is a decent earnings trade, and I like selling an iron condor for an earnings trade because it has limited risk. I think with earnings trades, what I can tell you in terms of what I believe in the most is if you're trading earnings, you have to have limited risk. I would not ever recommend trading earnings and selling a straddle or selling a strangle, which means that you are shorting naked options and you have no protection for big movements in either direction. I think shorting straddles, shorting strangles, or selling puts or selling calls all by themselves through earnings, I think that's a death wish, personally, because an earnings announcement is one time when a company will be able to come out and deliver news that is unexpected. And since it's an opportunity to deliver unexpected news that's not even related to the earnings announcement, first of all, they could report really bad or really good earnings relative to the consensus, and that could cause a big jump in the stock price. But they could also deliver news that was not even on the table as being expected, and that unexpected delivery could cause a huge movement in the stock price. And therefore, I think trading earnings with short naked options, meaning you're selling calls or selling puts by themselves without protection, I think it's a horrible strategy. And I think if you do that over a long enough time frame, you'll have certain earnings trades that will get completely blown out, and I don't think it's worth it. So if you're going to trade earnings, just do so with limited risk. So instead of selling a call all by itself, sell a call spread. Or instead of selling a straddle, sell an iron butterfly, which means you sell a straddle, you buy an upside call, you buy a downside put. You limit your risk. So that's my earnings trade advice. Josh asks, what is a debit spread and credit spread technically called? Like, what is a diagonal spread? Well, a debit spread and credit spread. A debit spread is when you buy a vertical spread. So if you pay to enter a call spread, that's a debit spread. If you pay to enter a put spread, that's also a debit spread. So it's a put call spread if you pay to enter the call spread, and it's a call debit spread if you pay to enter the call spread, and it's a put debit spread if you pay to enter the put spread. A credit spread means that you collect premium when you enter the trade, which means you enter the trade by selling the spread. A diagonal spread is when you have essentially a vertical spread, but you're using two different strike prices and expirations. So if we think about two axes here, this is the time axis, this is the strike price axis. When you trade a vertical spread, you're trading two different strike prices in the same expiration cycle. So the only difference between your two options is the strike price. They have the same expiration. When you trade a calendar spread, they are sometimes referred to as horizontal spreads, and a calendar spread is when you trade the same strike price in two different expiration cycles. So notice we're not on the strike price axis, we're on the time axis, which is why it's called a horizontal spread. So if you trade a calendar spread, which is when you sell a call and then buy a call at the same strike price but different expirations, that's called a calendar spread, or sometimes it's called a horizontal spread. And a diagonal spread is the combination of a vertical spread and a calendar spread, meaning that you have not only different strike prices, but you also have different expirations. And so if we were to plot the strike prices across time, we would get a diagonal shape. So that's kind of how I interpret it. Man, Lynn, thank you for the super chat. I appreciate it. Why do people use ES to hedge their portfolio? Why don't they use SPY? So if you're not familiar with what ES is, this is ES/ES. This is the E-mini S&P 500 futures contract. The reason someone would use this to hedge their portfolio as opposed to SPY is because this is a highly leveraged product, which means you don't have to put up that much margin to actually trade this. So this product is $50 a point. And so if I multiply the price of ES, which is $4,000 times $50, that gives me a notional value of $200,000. And so if I bought, let's just see here. So it says if I wanted to buy one of these ES futures, the buying power requirement would be $12,000. So if I use $12,000 to buy this futures contract and ES goes from 39.08 and it goes up 10 points to 39.18, I will make $500. And if I wanted to create the equivalent position in SPY, which would be, how do we get to 200,000? Well, I'd have to buy 500 shares. So if I wanted to buy 500 shares of SPY, then I would need $100,000 in margin as opposed to $12,000 in margin. So using an ES futures contract, which is the S&P 500 futures contract, as opposed to using SPY shares, the reason that I would use ES is because it's much more efficient in terms of how much money I need to actually hedge my portfolio. So if I'm using ES in terms of hedging my portfolio, I only need $12,000 in margin to actually enter one ES contract. But if I wanted to trade the equivalent size in SPY, I would need to trade 500 shares of SPY, and 500 shares of SPY would require a margin requirement that is way higher than $12,000. And if we look at it here, if I wanted to short 500 shares of SPY, then I would need $100,000 in margin requirement. This is a great question. Hi, Chris. Great tutorials and options. Thank you. The question is, when you are bullish, what is the difference between buying calls and selling puts? I would appreciate some explanation. So this is a very common question. The difference is what you're risking and what you can make. So let's say I think SPY is going to go from 390 to 400 or whatever my bullish assumption is. Let's say my trade is to first analyze buying the 390 call. And if I buy the 390 call in the March expiration cycle, I have 28 days left before this option expires. This 390 call is trading for $7.39. The most I can lose on this call purchase is the price that I pay for it, which in this case is $740. But I have unlimited profit potential because if SPY goes to 1 million, then this call option is going to make me a lot of money. And there's no limit to how much money I can make because a call option's value is derived from the stock price. And since there's no limit to how high the stock price can go, then there's no limit in theory as to how much this call option could be worth. So if I buy the 390 call, I can potentially lose $740, but I can make unlimited amounts of money. If I instead were to short the 390 put, meaning I sell it, this is a bullish trade because I will make money if SPY goes up, because as SPY goes up, this put option's value will decrease. And the best case scenario is that at expiration in 28 days, this 390 put will be worthless, meaning it won't have any intrinsic value, and an option at expiration with no intrinsic value will be worth $0. So if I short this put for $7.40, then the most I can make on this is $740. And we can see that it says on the platform right here, it says the maximum profit is $740. However, if we look at the maximum loss, the most I can lose on this trade is $38,000. And that would require SPY to go all the way to $0, which would not happen because that basically means that the world was hit by an asteroid and we're all dead anyways. But regardless, the maximum loss potential here is much larger than the call purchase, which was $740. So the difference between buying an option and shorting an option when they both represent a bullish or bearish trade is that when you buy an option, you will have low risk and incredibly high profit potential. But when you short an option, you will have very low amounts of profit potential and massive amounts of risk. And also the difference gets to the probability of making money. If I buy the 390 call for $7.40, then I need SPY to go up to 397.40 in the next 28 days. Otherwise, I lose money. If I short the 390 put for $7.50, all I need to happen is for SPY to remain above 382.50 over the next 28 days. So comparing buying the call to shorting the put, when I buy the call, I have low risk but huge profit potential, but I also need to be right about the stock price increasing, and I need to be right about the time frame that it occurs in. When I short a put, I have a little bit of profit potential, a massive amount of risk, but I can see the stock price move against me by a certain amount, and I can still make money. So I have a higher probability of making money when shorting the put as compared to buying the call. So the main differences are buying an option versus shorting an option when they represent the same direction in terms of how they make money. The difference is when you buy an option, you will have a little bit of risk and you'll have massive amounts of profit potential, but a low probability of making money because it's a more aggressive prediction. But when you short an option, you will have a little bit of profit potential, a massive amount of risk, but a higher probability or a higher likelihood of making money on that trade. So that's the difference. I am Dillian. Thank you for the super chat. I do Forex, but I came to options. I love and know everything about gold, so I decided to do gold options. I have a trading plan, but time decay has been kicking my butt. Any tips on how I can overcome time decay? So there's really no way to fight it because time decay is essentially your cost of owning that option. It's your daily cost of owning that option. So because you have a massive amount of profit potential and a little bit of risk, you're going to have to pay for that risk profile every single day, especially when you're wrong. And so if we just looked at the 167, let's look at the 167 call. We can see that the theta here, it says minus 5.3. And that means I'm expected to lose $5.30 with each passing day if GLD does not increase and I purchase this option. So there's really no way to fight it except to not buy options outright and do a spread instead. So for example, if I were to do the 165, 170 call spread, we can see that my maximum profit and maximum loss are going to be way different than just buying the call outright. But we can see by doing this spread, I reduce my theta to negative 0.2, which means instead of losing $5.30 per day, I'm only losing 20 cents per day because I will be losing money steadily on the 165 call that I own, but I will be making money on the 170 call that I'm short. And so the time decay of those two positions somewhat offsets. And in this case, the theta decay or time decay is around 0, which means I basically won't lose money from time decay if GLD stays right where it is. So that's really the only way to fight time decay, is to have an offsetting option that is profiting by the passage of time while your long option is losing money from the passage of time. But if you own an option outright, you will always have exposure to time decay, meaning that you will be losing money as time passes. The only exception to that would be if you own an option that is so far in the money that the option doesn't have any extrinsic value. And if the option doesn't have any extrinsic value, then there's no value to be lost with the passage of time. because only extrinsic value decays. Intrinsic value does not decay. I'm going to get to some of those other questions. I just got to prioritize the super chats. Icy, thank you so much for the super chat. I appreciate it. Icy says, learned options through your channel and YOLO'd my life savings in GME and made life-changing money. Thank you. Oh my God, I thought that was going to end with such a different sentence. I thought he was going to say, I YOLO'd my life savings in GME and lost it all. Well, I'm so glad that you made money on that trade, especially life-changing money. I'm glad that my videos could have helped you, put you in that position. But I just want you to know that GME is a very special case. I'm glad you made money on it, but just have your expectations in line with what you should be expecting in the future, which is that a GME, as we saw a GME in recent weeks, that's like a once in a lifetime thing. Like, I've never seen that, and I've been watching the markets very closely for the past 8 or 9 years. So just understand that you got really lucky there, but not completely lucky, because you took the risk and you put yourself in a position to profit from that situation. But just understand that a GME short squeeze from $5 a share to $400 a share, it doesn't happen every year. But thank you for your super chat. Thank you for your comment. And I'm glad you made life-changing money. Oh, man. All right, I'm looking for another question here. Josh asks, what are the best indicators to use when buying options? I think you mean technical indicators. Personally, I don't use technical indicators. The way I made money last year was just based on government policy, to be honest with you. So last year, I got to pull up a different chart. So last year, when the coronavirus started, I made a bunch of money through long VXX calls. So VXX is a volatility ETN. And as we can see here, in March of 2020, VXX went from $15 all the way to $80. So I made a bunch of money in VXX calls during this rise. And I remember last year when we started to rally off of the lows in March. So in late March, once we got 10% off of the lows, I started to bet heavily against the market right around here. And I was continuously adding to my short position, and I kept losing money. I was just burning money away. And all of a sudden I had this realization, and my realization was, first of all, the shocking event is already behind us. And typically the initial drawdown is typically the most violent, especially when we're talking about an increase in volatility products such as the VIX or VIX futures and VXX, which are all intertwined. Usually the biggest increase in those happens during the initial shock. And so after I started losing money and we were continuing to rally, I started to second guess my short position. And another thing that was in mind was, well, every time the market has gone down, the government has come out and said that they're going to print unlimited amounts of money, and they're going to do whatever it takes to make sure that the economy is good. But really, when they said economy, I think they meant stock market. And so with that in mind, I completely switched my position, and I closed my short positions, and I established some long positions that I was following in specific stocks. One of them was Tesla. But I also had some long positions overall in SPY and some other stocks such as NVIDIA. And I basically I put a bunch of leverage to the long side, and I let it rip. And the backdrop of that decision was not that I expected the market to get back to all-time highs or even surge past it as we saw. My assumption or my backdrop for that decision was that it would be more likely to see more positive outcomes, especially usually whatever you think is like the most obvious thing to happen, usually the opposite thing happens. And so since we had the worst world ever, and everything was shutting down and there was no economic activity, and you just thought to yourself, like, how could companies be increasing in value? How could the stock market be doing well when everything else seems to be doing so poorly? Everyone is expecting the market to collapse again, and for that reason I just kind of decided to go against it. And as I said before, I didn't expect the market to get back to all-time highs so quickly, and I did not expect it to extend the rally as viciously as it did. But I didn't base that decision off of any technical indicators or moving averages. It was just the backdrop of what the government was saying and how the market was reacting every time they came out to say something. And so that was really the backdrop of my decision. And even to this day, I think that it is probably better to be long the stock market as opposed to bet against it, because right now we are in an interesting investment environment where anybody who wants to invest their investable income and put away some savings, you're incentivized to go to the riskiest assets because you're going to get a negative return everywhere else. So if you invest in government bonds, first of all, you're getting very low yield and you're getting paid in US dollars, which are being printed at an alarming rate. And so you have a negative return because inflation is 2% or whatever, and they want it to go higher. And if you're getting a 0.5% or 50 basis point return on your savings account, then you have a negative real return, which means your purchasing power is being degraded over time. And so the only way to get a positive return is to go to riskier assets. And so I think in this current environment, risky assets are still going to perform well as long as the monetary policy stays where it is. And so even though we look at this stock market chart right here and say this is ridiculous, it's got to come crashing down. It will come crashing down at some point, but that could be 5 years from now. And as long as the monetary policy is what it is, and where we have an investment environment that favors very heavily investing in risky assets, I think it's smarter right now to be long stocks than to bet against them. And so to make a short question very long, do I use technical indicators? I do not. I think it's better to use kind of a more macro backdrop, but super experienced investors will also tell you that using macro backdrops doesn't always work. So I don't know. That's my answer. All right, I got to catch up again. Manuel, thank you for the $5 super chat. I appreciate it. Your 2-hour video on options is the most helpful video I've ever seen. Ever since I watched that video 1 month ago, I've made $14,300 since. Thank you. You're welcome, Manuel, and I'm really psyched on your profits. Good job. Keep on learning. I know this stuff can be very difficult and there's a lot of moving parts and options, but I have always said, I've been more vocal about it recently, that learning options and just knowing when you can use them, even if you don't use them all the time, I think that's an extremely valuable thing. And recently I've kind of been thinking about it like a car. Options trading should be thought of like a car. Like, you don't drive your car around all day long for 24 hours a day. Just because you have the car doesn't mean you always need to use it. And I think options kind of fit in that same wheelhouse, is that knowing about options is extremely valuable, but you don't necessarily always have to be implementing or trading options. But yeah, man, I'm psyched on your $14,000 gain. Keep it going, keep learning, and let me know if you have any questions. I'm happy to help. Sean, thank you for the $5 super chat. Do you offer one-on-ones or a masterclass? If so, how much do you charge per hour or annually? If not, have you considered starting a masterclass? I do not offer one-on-ones, and I do not have a masterclass. And my reasoning for that is, if I were to do a one-on-one session with you and you asked me a question that anybody in this chat is asking, then I would give you the same response. And so I've said it before that these live streams are kind of like a one-on-one, because I get to answer questions that people have that I think are good questions. And it's probably a question that a lot of people have. And so if I can give you a very in-depth answer where it's not in one of my other YouTube videos where I kind of craft them to be more engaging as opposed to going super in depth, then like these sessions are kind of like a one-on-one, even though it doesn't feel like it because there's so many other people watching. But I do not do one-on-ones. I do not have a master class. But I'm going to craft something that is going to be something along the lines of a master class, but it's not going to be like how to make $1 million trading options. It'll be more along the lines of my 3-hour options for beginners video, but it will be much more refined and it'll go into a lot more topics, and it will mostly be written with video complements, and that's kind of what I'm thinking of. But I probably won't sell it either. So I'll talk more about that in the future. Got another one from Campbell. Campbell, thank you for the super chat. Appreciate it. What methods do you recommend to identify critical levels and how effective options order flow data analytics software like black box stocks are in giving edge? So this is kind of a technical analysis question. And as I said before, I don't really use technical analysis in my trading. So in terms of identifying critical levels, like if I were looking at this chart of SPY, I would just kind of eyeball what seem to be critical levels based on the price action. So we could argue that 320 is a pretty serious price level or a critical price level because we saw that we got a big rally and then we bounced from it and then we got another decline into it and it bounced again. So we could say that 320 is a critical level, so to speak. But other than that, like I don't really read too much into that. Like I wouldn't place a trade based on what I said and go into it with a overconfident mindset, meaning that like I'm going to sell the 320 put and it's going to be free money because this is a critical level and it's not going to be violated. I wouldn't really approach it like that. And in terms of options order flow data, I have looked at some options order flow data before and used some services, but mostly that was just kind of a free trial type of thing where I was just seeing what the software would tell me. And it is interesting. It's kind of fun to watch the big order flow data for options, but at the end of the day, you don't know who is making those big trades and you don't know why they are making those big trades. So like for an example would be somebody could have a massive short position in a stock, and then to hedge that position, they could buy thousands of deep out of the money call options. And if you're only looking at that massive order flow, which is somebody came in and they bought thousands of out of the money calls, you could interpret that as this person is extremely bullish on this stock. They know something and I need to follow this trade because if they're putting thousands of contracts or they're buying thousands of contracts of out of the money calls, then I need to follow that trade because that's such an aggressive trade that they must know something and I would be stupid not to follow it. But you don't see their whole portfolio and you don't understand that they have a short position. They're actually betting against the stock, but they put on a very cheap hedge in the form of deep out of the money call options with thousands of contracts. And so the options order flow thing, it's interesting to look at. It's fun to look at the huge orders that are coming in, but unless you know the context of those trades, then I don't think it's extremely telling or predictive. But I'm not an options order flow expert, and I know there are traders or services out there that they kind of specialize in watching the order flow data and then they follow or piggyback on those trades. And they probably have better systems than I do, but that's just kind of my 2 cents on looking at options order flow data and trading based on simply looking at the big orders. I am Dillian asks again, another super chat. Appreciate it. Last question. What is a good option strategy when dealing with low volatility? So low volatility, I typically favor option selling strategies in low volatility environments. And I know I've said that before and it caused a stir in a past live stream because I know most people have learned that when implied volatility is higher, then options are more expensive. And therefore, when they're more expensive, they're better to sell. But I talked about how we don't really have that much data for ultra high implied volatility environments. And I have read things and I've looked into data myself that suggests selling options in super high implied volatility environments is not as easy of a trade as it may seem. And the options are so expensive because there's so much movement. But when you have an ultra low volatility environment or a lower volatility environment, the options are cheaper, but the market is also much more calm. So like if we look at these past few days in SPY, like this is an ideal environment for an option selling strategy right here, because you're not getting huge daily movements and the market's just kind of chopping around, as opposed to like, do you want to be selling options through something like this? Like this is a lot more market movement, and you're going to probably take a lot more heat on selling options in this type of environment because the market movements themselves are much more choppy, and that's why the options are more expensive. So I know there's no perfect recipe. As I said before, there's no perfect time to enter any trade, but for low volatility environments, typically I would lean towards if I was going to do an option selling play, I would probably do something like an iron butterfly, which is basically you sell a straddle and you buy an out of the money call and you buy an out of the money put. So an iron butterfly is essentially an iron condor. You just have the same short strike. So instead of having the call spread and the put spread, you have the call spread and the put spread, but the short strike is the same. So that's probably what I would do, or I might do like a directional butterfly. So if I think that SPY is going to continue grinding higher, I might do a bullish butterfly, which could look something like, it depends on how high I think the market was going to go, but if I thought the market could go up to 400 in the next 30 days, then maybe I'd do the 390, 400, 410 call butterfly. So this would be something that would be interesting to me if I thought that over the next 30 days the market would trend towards 400, because now I have this trade where I can only lose $300, but I can make $700 if I'm right about that slow drift towards the 400 level. But then you could also, do a call spread, but if we look at here, like the risk reward is a little bit more even, which I don't know, it's not as favorable. Typically, when you have a directional option strategy, you want implied volatility to decrease. And if you have a low volatility environment, then obviously you can't really benefit from that. So in a lower volatility environment, you're typically making money from time decay as opposed to a big decrease in implied volatility. But that would probably be, I know that's probably not a great answer, but it's tough. But in low volatility, I do favor option selling strategies, or it's also a good time if you think that a bull run will continue. Then since options are cheaper in that lower volatility environment, then it's also a good time to buy options if you want to. But again, lower volatility, smaller movements in stock prices, buying options, not as favorable, I don't think. Joseph asks, are you in Chicago? I am not in Chicago. I am in Denver. I used to live in Chicago. I grew up in Chicago. That's where I got my start, but now I live in Colorado. We got another one. Let's see here. Ruin asks, what is the best time frame for selling covered calls? In your opinion, of course. My preferred time frame, if I were to sell a covered call, I don't really like covered calls, to be honest. But my ideal time frame would be less than 60 days for sure. I would say, like, if I was going to do a covered call on Apple, the furthest out I would go would probably be 60 days. And that's just because I think when you're trading a covered call, you want that short call that you've sold, you want that to lose value through time decay. And the longer term you go, the slower the decay will be on that short call. And that's why I think it is less ideal. So there's kind of a sweet spot between going too short term and too long term, because if you go too short term, then you're going to have to sell a call that's really close to the stock price. and you're not going to collect much premium for it. Whereas if you go super long term, you can go much further away from the stock price, but you're going to collect a lot more premium as well, but you're not going to see a lot of decay from that option. And so I think like 30 to 60 days is probably the sweet spot for covered calls, because you can get a good distance away from the stock price and collect a decent amount of premium. And then you'll also be adjusting or resetting that covered call more frequently, as opposed to selling like a 120-day covered call or something like that. So really quickly, just to show what I mean by that, is let's look at the 28-day option in Apple. So these options have 28 days to go. The stock price is at 130. If I go to the 140 call option, I can short this 140 call for $115. So if this was part of a covered call, then I could sell the 140 call and collect $114, which would reduce my loss potential on the position overall by $114, or it will also enhance my return if Apple stays below 140 by $114. If we go to the April 2021 expiration, now we have 56 days to go. Now let's see how far away we can go and get $115. Look, we can go to the 150 strike. So if I wanted to collect $100 on a covered call, if I go to the 56-day cycle, I can get 20 points above the stock price, which means as long as Apple is below 150 through expiration, then I will keep the $115. But if I went to March, then I could only get that amount of money by going to the 140. And so there's a $10 difference between where the stock price needs to be and where I can make my most money. So if you go shorter term, you're going to have to get closer and closer to the stock price. And to kind of exaggerate this once more, if we go to the options expiring in 13 minutes, then we can see if I want to get, well, basically I'm not going to get $100 because I could sell the at the money call, which is the 130 call, and I can collect 10 cents on this. And Apple is at $129.990 or $129.99 right now. So this, you can't really do anything here. So my final answer for the optimal time frame for a covered call would be 30 to 60 days. I have a really good track record of taking a long time to answer short questions. I'm sorry. Or maybe you guys like the depth. I don't know. Let me know. Renzo asks, does theta act throughout the day or does it take effect at the end of every trading session? It is in theory, it's a linear thing. So it happens gradually, but you can't really tell. Like if I'm looking at these March options with 28 days to go, I'm not going to be able to visualize by watching the prices. I'm not going to be able to see the option price decaying because it has 28 days to go. And if I looked at the expected price decay here, like the theta on the 130 call says -7. So that means that every single day, if nothing happens and the Apple stock remains the same, then my position would be expected to lose by $7. And in option price terms, that's 7 cents. So this option is $4.25. And if theta were to kick in, then this $4.25 option would go to $4.18. And you're not really going to visualize that because the stock price is moving around all day long. And so you can't tell whether or not the option price is changing based on the stock price changing or if it's from the passage of time. But what I would really recommend, so you can understand this, is on the day of expiration, like today, you would look at an option, but preferably you start at the beginning of the day because since we only have 11 minutes left, we're not really going to be able to tell. But we can sit here and we can watch this 130 call. So Apple is at $129.94, and we can just look at the price of this 130 call. It's basically worthless. It's only 5 cents. But in 5 minutes from now, assuming Apple is below 130, this option price is going to continually go towards zero. But I would really recommend doing that exercise and starting at the beginning of expiration Friday and then just watching the price of a position change as the closing bell gets closer and closer. And what I would recommend is, instead of just looking at one option, maybe you can set up a straddle or something and just look at the price of it. Don't actually trade it, just watch the price. So if today, like an ideal time to do this would have been today in the morning, right when the bell opened, to look at this straddle or look at some sort of at the money option and watch the price of that position throughout the day. And if the stock price is changing, you could also just change the strike price of the position. So if I'm looking at the at the money straddle here, which is basically the closest strike price to Apple's stock price, since Apple is very close to 130, the at the money strike would be 130. And so I could just queue up the 130 straddle in the morning, and this probably would have been a couple dollars, but now it's at 15 cents. And that's because there's 9 minutes until they expire. And so they basically have no extrinsic value, because in the next 9 minutes, there's not a large expected move for Apple. But you can really see the effects of time decay on the day of expiration if you look at the prices of at the money options from the opening bell all the way to the closing bell, and then observe those prices. That's what I would actually really recommend, so that you can see time decay in effect. SOS. Ibiza asks, is there any difference between SOS and MSTR to have exposure on Bitcoin? What is SOS? I don't know what SOS is, to be honest with you. But MSTR, which is MicroStrategy. MicroStrategy, this is basically a Bitcoin holding company at this point. MicroStrategy was a technology company, and MicroStrategy was the first publicly traded company where the CEO came out and said, we are putting 100% of our cash on our balance sheet into Bitcoin, which was like $500 million at the time. And this was way back here, or earlier this year, I should say. And essentially what happened is they came out again and they said, okay, we're buying another $250 million in Bitcoin. And then they came out again and they said, we are issuing $500 million of debt to buy more Bitcoin. And then just the other day, they came out and said, we are issuing another $1 billion in debt to buy more Bitcoin. So this stock is essentially a Bitcoin holding company at this point. So I'm not sure what the difference between, I don't know what SOS is, but to make a long story short, the company that has the most exposure to Bitcoin will more closely track Bitcoin fluctuations. So an example would be Square. I think they bought $50 million worth of Bitcoin. And so Square is much less of a Bitcoin exposure stock than MicroStrategy, because MicroStrategy at this point has bought billions of dollars of Bitcoin. So they have much more exposure to Bitcoin than Square does. And in terms of a percentage of the company's value, Bitcoin makes up a considerable amount of MicroStrategy's value at this point. So MicroStrategy compared to SOS, I think MicroStrategy probably is a better Bitcoin exposure stock. But again, I don't know what SOS is. But at the end of the day, like if you're trying to get exposure to Bitcoin, the best way to do so would be to buy Bitcoin. But if you're trading in an IRA or something, and you're trading in an account that you cannot put that money into Bitcoin, but you can trade stocks, then buying a company like MicroStrategy is a good option, because you will get exposure to Bitcoin through owning that company. Litecoin, I don't know much about Litecoin, to be honest with you. But I will be, Lone says wrong channel. So I will be doing some crypto related content in the future. My decision is that I am going to be doing more broadly focused content on Project Option. It will still remain options focused, but some of you may know that a few months ago I started a second channel, and my focus on the second channel was to do more broadly focused investing content. And the reason I did that is because I wanted to keep this channel options focused, and I didn't want to blend the two. But at the end of the day, it doesn't make any sense for me to spend time on an investing related video and upload that video to 10,000 subscribers when I could upload it to Project Option, which has 240,000 subscribers. And my final reasoning for doing that is if you're watching Project Option, then you're interested in options trading. And if you're interested in options trading, then you're interested in making money. And in my opinion, if I have something to share with you that I think will improve your odds of making money, then that aligns with what Project Option is all about. Because my goal with Project Option is to educate you about how options work so that you can potentially use them to make money. And if I have other things that I want to share with you that are part of my philosophy that I strongly believe in, that I think will help you make money, then I'm going to share that with you on this channel as well. So if you don't want any broadly focused content on this channel and you just want option stuff, and I'm sorry, but you're going to get more broadly focused content in the future, including crypto related content. All right, I have to go, unfortunately. I have to go. I have a important call in 4 minutes here. But thank you everybody for tuning in. I appreciate everyone's questions. I appreciate all the participation. I appreciate the super chats. Thank you for your support. Yeah, I'm going to try to get on more of a regular schedule with the live streams, but the winter is kind of crazy for me just because my family strictly does skiing vacations, and so that's kind of the busier season for me with family trips and the holidays and snowboarding and stuff like that. But I'll be doing a live stream pretty much once a week. I just don't know what the schedule for that is going to be. But I'm going to start posting a day before or 2 days before. If I know what day I will do a live stream, I'll post on the community tab, or I'll do a post on Project Option saying I'll do a live stream this day at this time. So you'll have more of a warning before I do live streams. All right, I got to go. Thank you so much, everybody.